Howdy, hotshots. It's the Dividend Daddy, your favorite, not a financial advisor with not financial advice. I'm going to talk to you about ULTY's NAV erosion, or NAV decay, or reduction in value, whatever it is that you prefer to call it. I started buying ULTY July 10th. And I started buying it at $6.24, and I bought it all the way up and all the way down, all the way till my last purchase today, which was about 57 shares or 56 shares of ULTY using my distribution reinvestment. I was looking at the lots that I purchased, the return of investment on each individual purchase along the way. Now, I did not calculate my total return based on how much money I am out of pocket for ULTY, but I made several purchases in that time period. I was buying 5 shares, I was buying 15 shares, I bought 444 shares one time because that's how much money I had in my account. I bought 500 shares in one day because the price kept dropping and I kept catching it with my ULTY waterfall method. And if you're interested in that, find my ULTY waterfall video. It's how I set up my purchases to incrementally increase the amount that I'm purchasing as the price falls, utilizing limit orders. I am still happy with ULTY based on how it has performed over the last couple of weeks. Even today, there was a lot of stocks down and ULTY held up pretty well, especially considering there was a distribution today. I was very surprised to see it rebound so quickly after its ex-dividend date yesterday. It immediately was up yesterday, and I had anticipated that it would be kind of down for the 9.5-cent distribution rate that it had declared, and that it would stay down for the day, but it came up about 8 cents. It's back down some today, which was actually pretty good because I got my distribution and was able to pick up my shares on drip at $5.76. But I just looked and it's down to $5.70 after hours. So, we got a little bit lower distribution this week, 9.5 cents, which is still not bad. And it kind of correlates with the amount that ULTY price dropped the last couple of weeks. I am thinking that ULTY's price drops kind of correlate with market drops because it's holding a basket of stocks. And so the volatility increases when stocks go down in value. So I feel like you could see a week or two in arrears when that distribution rate is affected by the new price, because initially when prices go down, volatility goes up, which increases options premium. And so it seems to me that initial week could be compensated, the lower price could be compensated for by the increase in volatility. But as volatility decreases, like we saw this last week, where all of the covered call funds for the most part had to cut their dividends because of volatility decrease, then that's when the lack of growth in the NAV starts to catch up with us. So this week, the distribution was down about 5%. ULTY is down about 5%-ish, off of $6. So it kind of correlates pretty directly. And I will say that, all of these things go hand in hand. I've made a response in the comments below that have said that. Distribution rate, volatility, and NAV all dictate how much your premiums are going to be off the options that you can sell based on the positions that you have. So if NAV goes down, then eventually your distributions are going to go down. If volatility goes down, then your distributions are going to go down. So if your NAV is down and your volatility is down, your distribution could go way down. Luckily, it didn't go way down. I mean, a half a cent isn't that big of a deal. Although, even though I used my drip last week to buy 57 more shares, this week, because of the lower distribution rate, I was only able to pick up 56 shares on my drip. So that I had 57 extra shares earning a distribution, but I was able to reinvest at a lower price at 56 shares. So I did get a few less shares this week than I was anticipating. It's not a big deal, but it is worth noting. But I wanted to talk about the reduction in NAV. I started buying in early July. I made purchases all the way up to $5.45, and I made purchases all the way down to $5.76. every single one of those little lots that I had bought is in the red, okay? I've had a negative capital return on each one of those lots that I bought, every single one of them. I compare this with Qqqi, which I had also started buying right around the same time. With the exception of the last purchase, my last dividend reinvestment, every single one of those lots was in the green. So if you aren't happy with ULTY's volatility and you don't think the total return is enough to make up for that volatility, or if it's making you nervous, or if you're looking to diversify with your dividend distributions, maybe Qqqi is a good way for you to go. Another one that I've been really happy with the performance of, and I'm also really happy with the distribution rate, which last time I checked was north of 40%. I'd have to look again because they change every week, was GDXY. I started buying that one on July 2nd, and every single one of my purchases in that one is in the green. Some of them as high as 9%. So I've had really good luck with GDXY. I would say that ULTY, probably after this distribution, I'm slightly in the green. I'm at least like very close to break even, which hopefully means that as long as their NAV stabilizes here or goes up a little bit, then I'm going to be getting some gravy. I'm going to be cushioning my cost basis a little bit so that I have room for the NAV to decay some more. Qqqi is what I'm definitely going to be building on. I am much more comfortable. I know a lot of you out there have huge positions in ULTY. ULTY is currently my biggest ETF position. I have SCHD. I've had that for a while, that I just was putting money in whenever I had extra money to put in somewhere and couldn't find something else that was more interesting. VGT I have, VOO I have, VOOG I have. I have kind of a lot of SLV in one of my IRAs because I really believe in the future of silver. And even though it's not holding silver directly, it's a lot easier to invest in SLV than it is physical silver. It's easier to liquidate because it's so liquid. You can just buy or sell it anytime you want to. You don't have to worry about storing it. You don't have to worry. SLV is a perfectly good investment for me. I've been buying that for 15 years. So I have a pretty sizable position in SLV, and it has performed not as well as the market overall for me, but it has performed better than it would have been if I was sticking that money in a bank account. So I'm happy with SLV. I have GDX, which I've had for quite a while, a smaller position than SLV, and GDX has performed pretty well for me. And so that's why GDXY was so interesting to me, because I believe in the future of precious metals because of the inflation that the government just has a mandate on us to accept. And so I like GDX, I like SLV. If they came out with an SLVY fund that was paying, I would 100% be interested in buying that. But I have GDXY, and I have been green on every single purchase. Qqqi, I have been green on every single purchase. Now, does that mean that it's always going to be green? No, of course not. I have seen it dip down into the red a couple times, but it's been relatively stable. ULTY, on the other hand, has been decaying since I bought it. Now, it's only been a couple months, so it's not like I can, say that this is a terrible investment. I'm not selling my ULTY, okay? I'm reinvesting dividends, so I'm actually still accumulating it. I'm in the accumulation phase of all of these funds, but I'm deciding where I can put more and more money. Now, I'm not gonna start right now taking my distributions out of ULTY and putting them in Qqqi. I still think there's a good chance that my total return from ULTY will be higher than my total return from Qqqi. But I am more comfortable putting a larger amount of money in Qqqi because it's got an underlying index that I think is going to consistently grow over time. Now, we could go into a bear market and it could be down for a couple of years, but over time, I believe that Qqqi will grow. The chart moves up and to the right, as opposed to ULTY, which is trading in and out of stocks all the time. And so you really can't get a good read on where the underlyings are going to go. That doesn't mean that they're making bad decisions or that they will in the future. Hopefully they're experts and they make great decisions and they're worth their management fee. But you can't really judge whether or not ULTY will consistently perform well because they move in and out of stocks. It's not a basket of stocks like an ETF or like an index is. So I am more comfortable at this point in time putting more money in Qqqi. Now I'm very happy with GDXY's exposure, the exposure that I've had to GDXY, and I'm happy with the performance I've had from it so far, but I'm not that comfortable putting as much money in that as I am in Qqqi either, even though the distribution rate is so much higher because they use derivatives in order to get their income. And to me, that automatically makes the fund a little bit more risky because if they're using derivatives, then it can go south really quickly. But gold has been performing well recently, and I anticipate that it will continue to perform relatively well for the foreseeable future. So I will be building my GDXY position, but probably not as quickly as I'm going to build my Qqqi position, which is still giving you a yield of 14% or greater, and it's going to have a performance that is closer to what Qqqi would. Probably not match Qqq's overall performance, but I like the idea of having income to cushion any kind of downturn. I like the idea of accumulating shares so that it produces more and more income. And I like the idea that I can just take the income off without selling the shares, even though that's almost a semantics thing too, because if your fund is growing and you get less and less shares, but you're selling it off for income, you know, it can be a wash. So I'm not saying that that's actually a good financial decision, but it's something that I feel comfortable with and I feel happy about, and I like seeing those dividends come in. It's kind of a rush that I get when I see them come in. But ULTY is my wild card. And so I have quite a bit of money in it right now. I have close to 4,000 shares stretched across my accounts. Nothing like what some of you guys have. But I'm getting, you know, close to $400 a week on it at this point. And I love seeing it buy, you know, over 50 shares a week and knowing, hey, I'm going to get 50 shares worth of distribution next week. But all of that is to say that when I look at all of my purchases for ULTY, they're all in the red. It's been a short period of time and the distributions are massive, and so it does make up for that. But you have to be prepared for the possibility or eventuality of your ULTY NAV going down. It didn't for a couple months. From April to July, it was doing really well, but then from July to the end of August, not so well. Now, you know, when the old adage from the traders was sell in May and go away, right? Because all summer long, things really just kind of languish. People are on vacation. They're not really involved in the markets as heavily as they are the rest of the year. And so there's quite a possibility that assuming we still have a good market through the end of the year, that things start to pick up a little bit. You know, and ULTY could build back up into that 650 range. I'm not saying that it can't, and I'll be happy to see it if it does. But I want you to be mentally prepared for the possibility that that's not how it is. We know that ULTY changed in March, okay? And so we can't really look at the fund before that as far as what to expect for performance, even though, as they always say, past performance doesn't guarantee future results or is not indicative of future results, whatever. And this video is for entertainment only, and I'm not a financial advisor, you know that. But ULTY started out at $20. Now it's $5.70. I was buying it at $6.45. Now it's $5.70. So you can't be surprised if it goes down in value. I want to encourage you to look at your total return, okay, and see if you're happy with that total return. And if you're not, find a different investment. Qqqi would be a good one for you to look at. You could hedge your positions against inflation with a GDXY and still be able to get some sizable income. I'm going to keep adding high yield funds. I have quite a few of them right now. Over the course of July and August, I added a lot to my covered call funds, and I didn't have very much of those before. Typically, I was just selling my own covered calls, but I'm pretty busy, and I like having that professional management and being able to diversify amongst many stocks without having to tie up hundreds of thousands of dollars by buying 100 shares at a time, so I can either sell cash secured puts or covered calls. So I still think that these covered call funds are a great opportunity to get involved in options premiums with instant diversification and instant management without having to have a huge amount of money or spend a lot of time researching. You just have to understand that covered call strategies cap upside, but they don't cap the downside. Now, ULTY has puts that they use for protection inside the fund, and we did see those pay off pretty handsomely a couple of weeks ago when the market was getting beaten up. However, as you can see, the market typically rebounds quicker than what you're going to see out of one of these covered call funds because the covered calls are capping the upside. And so I want to know from you guys, tell me down below, which covered call funds do you have that have given you the highest amount of NAV return? And are you in the green on ULTY? And how long have you had it? All right, D-Gens, I'll talk to you later.